Stock Dividends Basics Problem 3. On June 30th, Year 1, Mango Inc. showed the following data on the equity section of their balance sheet. Stockholders' equity is as follows. Common stock, $1 par, 204,000 shares authorized, 158,000 shares issued and outstanding, $158,000. Paid in capital in excess of par common, $267,000. Retained earnings, $945,000. Total stockholders' equity, $1,370,000. On July 1st, Year 1, the company declared and distributed a 11% stock dividend. The market value of the stock at that time was $18 per share. Following this transaction, what is the balance of paid-in capital in excess of par common? So we're looking at dividends, specifically stock dividends. We're told that the company declared and distributed an 11% stock dividend. If you're told it's just a dividend, not stock dividend, remember it's going to be a cash dividend. But if it specifically says stock dividend, the question deals with stock dividend. Remember to focus on what the question's asking. If it's just asking for the total stockholders' equity after, it's just the before amount. If it's asking for the common stock after, that you're going to have to do a calculation. Here, it's asking for the balance in the paid-in capital in excess of par common stock amount. So we are going to have to do some calculations here. Now, we're given some information, June 30th, Year 1, Mango Inc., and we're told, again, 11%. We're told the market value of the stock at that time was $18 per share. That's going to be important because if you're doing if you're doing par, then you focus on the par amounts. If you're doing the paid-in capital in excess of par, you need to know both the par and the market amount at the date of issuance. Now let's go through the information. We're told that the number of shares authorized is 204,000. We ignore that. We're told the number of shares issued and outstanding is 158,000. We focus on the $158,000 shares, which equals $158,000 in this question. We're also given the paid-in capital in excess of par common, the $267,000. That's going to be important, so we're going to need that information. Retained earnings, we can ignore that. And the total stockholders' equity, we're not asked about total stockholders' equity. We can ignore that as well. So the common stock and the paid-in capital in excess of par, those two lines, they're going to be important lines to go through. All right, let's go through this. And what we need to do is we need to take the number of shares outstanding. We're going to start with the number of shares outstanding. That's always where we start. If you're trying to calculate the change in the paid-in capital in excess of par, which here we're told is 158,000. That is where you start, 158,000 shares. We're going to multiply that by the percentage stock dividend, which we're told is 11%. So we multiply by 11%, and that's going to give us the new number of shares, which is 17,380 new shares due to this stock dividend. Now, of course, there's 158,000 shares originally out there of stock outstanding. Now there's 17,380, so you add that to 158,000 to get the new total outstanding shares. Okay, once you get the new shares, all we need to do is take that 17,380 new shares, and we're going to multiply that by the difference between the market amount per share when it's issued, which is $18 right here. So $18 per share minus the par per share, which is $1. So that's $17. So we're going to multiply the 17,380 by $17. I know I put it here, but I also put it here as well. So 17,380 new shares times $17 per share, that's going to give us the paid-in capital in excess of par amount. If we were calculating the common stock, you would take 17,380 times $1 per share, get 17,380. That's what you add to the common stock account, $158,000. But we're calculating the paid-in capital in excess of par. So 17,380 times $17. We're going to multiply that together, and we're going to get $295,460. Finally, we're not done. So that is the new additional paid-in capital in excess of par for common. That's the new amount. That's not what the question's asking. It's saying following the transaction, what is the balance in the paid-in capital in excess of par? So everything together. We're going to take the $295,460 plus that we just calculated from the new shares of 17,380 times 17. We're going to add to that. We're going to add the $267,000 that we started with, and that balance added together, we're going to get $562,000 $460. And that is going to be our end answer. So we've just calculated the paid-in capital in excess of par common after the transaction, again, by adding the new additional paid-in capital to the old additional paid-in capital to get the new balance. So really, when you're going through these stock dividend questions, focus on what the stockholders' equity balance is before and after, which is equal. Focus on the common stock balance, which in this question is just $17,380 added to $158,000, old balance plus new, and then the additional paid-in capital in excess of par common. Now, retained earnings is going to reduce by the $18 price times $17,380. So that number is going to be more than over $300,000, and you're going to take that number and that's what retained earnings is going to reduce by. Because remember, looking at the balance sheet, assets equals liabilities plus stockholders' equity. Stockholders' equity is broken into two parts, paid-in capital and retained earnings. A stock dividend, because remember, WIRE, W-I-R-E. Some of you are probably getting sick of it already, but it's really important to understand. The I is for investments. It goes into paid-in capital. The W, the R, and the E, W for withdrawals, known as dividends, revenue and expenses. Those go into retained earnings. When you have a dividend reduces retained earnings. So here we have a stock dividend, $18 times 17,380 shares. We're going to bring that amount over to the paid-in capital account by increasing common stock by 17,380 and increasing the new by increasing the paid-in capital by this amount right here, the 295,460. That amount in total, again, is what retained earnings went down by. So after the transaction, stockholders' equity equals the amount before the transaction.